Something just shifted in the conversation about artificial intelligence. For the past 2 years, if you expressed skepticism about AI hype, you were dismissed as a Luddite who didn't understand the technology. But in the last few weeks, the tone has changed dramatically. And it changed because the people running AI companies started saying what critics have been saying all along: we might be in a bubble. I've been watching the AI investment mania with growing concern, and what I'm seeing now suggests we're approaching an inflection point. The numbers are staggering, the warning signs are multiplying, and even the true believers are starting to hedge their bets. Let me walk you through what's happening, why it matters, and what it means when the largest capital spending spree in corporate history collides with the reality that nobody's figured out how to make money from AI. Start with the spending numbers because they're genuinely unprecedented. According to multiple analyses, tech companies are projected to spend over $400 billion on AI infrastructure in 2025. That's not a typo. $400 billion in a single year, mostly on building data centers, buying Nvidia chips, and powering the massive computational infrastructure required to train and run AI models. To put that in perspective, the Apollo program that put humans on the moon cost about $300 billion in today's dollars, spread over a decade. The AI industry is spending more than that every single year. Amazon, Microsoft, Google, Meta, and Oracle are collectively devoting roughly half of their current cash flow to AI infrastructure. Think about that. Half of the cash these enormously profitable companies generate is being poured into data centers and AI chips. Now, here's where it gets problematic. While companies are spending $400 billion annually on AI, American consumers are spending about $12 billion per year on AI services, according to Wall Street Journal reporting. That's the gap. $400 billion in spending, $12 billion in revenue. One economic commentator framed this perfectly. $400 billion is roughly the annual GDP of Singapore. $12 billion is roughly the GDP of Somalia. If you can grasp the economic difference between Singapore and Somalia, you understand the chasm between AI spending and AI revenue. This is not how sustainable businesses work. You cannot spend 33 times more than you earn and call it a viable economic model. Now, some people will say, but this is infrastructure investment. You build it now, monetize it later. And there's some truth to that. The internet required massive infrastructure build-out before it became profitable. Same with railroads in the 1800s. But here's the problem. The pace of AI improvement has slowed dramatically. Paul Kudrowski, a venture capitalist now at MIT's Institute for the Digital Economy, put it bluntly: the technology is very useful, but the pace at which it is improving has more or less ground to a halt. This is critical. The entire investment thesis rests on continuous exponential improvement. Models keep getting better, applications keep expanding, revenue keeps growing. But if improvement plateaus, the whole equation breaks down. And we're seeing evidence of plateau. Large companies that adopted AI are reporting declining usage. The initial excitement is wearing off as people realize the tools don't save as much time as they cost in effort. AI fatigue is real. OpenAI's Sam Altman once joked that saying please and thank you to ChatGPT costs them millions of dollars. That's not actually a joke. It's an admission that the economics don't work. As usage grows, losses grow. There's no path to profitability at current technology levels. OpenAI is burning through billions of dollars in investment annually. They're not making money. They're losing money at an extraordinary rate. And yet their valuation keeps climbing because investors believe future versions will somehow solve the economics. This is speculation, not investment. It's betting on technological breakthroughs that may or may not occur. Let me talk about what happened in July that should have been a major wake-up call. An MIT study reported that 95% of organizations that invested in generative AI were getting zero return. Tech stocks briefly plunged when this news hit. The study itself was more nuanced than the headline, but the core finding was damning. Companies spent money implementing AI, and for the vast majority, it didn't improve productivity, didn't reduce costs, didn't generate revenue, zero return. That should have triggered serious reassessment. Instead, after a brief panic, investing continued at the same pace, because the narrative is too powerful and the fear of missing out is too strong. Then in August, Sam Altman said something remarkable. At a press dinner, he admitted, "Are we in a phase where investors as a whole are overexcited about AI?" This is the CEO of OpenAI, the company that triggered the AI boom, openly questioning whether there's too much excitement. Demis Hassabis, CEO of Google DeepMind, went further in November. He said, "It feels like there's obviously a bubble in the private market. You look at seed rounds with just nothing being tens of billions of dollars. That seems a little unsustainable." And in December, Anthropic's CEO Dario Amodei added his concern. He said he's confident in the technology but worries about the business side. If players just make a timing error, if they get it off by a little bit, bad things could happen. Read between the lines. The CEOs running AI companies are telling you there's a bubble. They're being diplomatic about it, but they're signaling that the valuations are unsustainable and the timing is precarious. Why does this matter to regular people? Because 62% of Americans own stocks according to Gallup surveys. And the stock market is heavily concentrated in AI-related tech companies. The top 20 companies on the S&P 500 account for 52% of total market value, with the top 10 dominated by AI companies. If the AI bubble pops, it's not just venture capitalists and Silicon Valley that get hurt. It's retirement accounts, pension funds, and anyone with savings in the stock market. The OECD released an economic outlook in December that explicitly called an AI bubble a key downside risk to the projection. They wrote, "Weaker than expected growth, lower than expected returns from net AI investment, or upside inflation surprises could all trigger widespread risk repricing given stretched asset valuations." Translation: if AI doesn't deliver the promised returns, the market could correct sharply and broadly because so much money is concentrated in AI bets. Let me talk about the energy problem because this is where physics meets economics. AI data centers consume enormous amounts of electricity. Current projections show data center electricity usage will more than double in the next 5 years. This is creating real infrastructure problems. Power grids can't handle the load. Some tech companies are installing their own natural gas turbines on site to power data centers because grid capacity isn't sufficient. Elon Musk's xAI and the Project Stargate joint venture involving OpenAI and Oracle are both doing this. They're building gas power plants next to data centers. This has climate implications that conflict with tech companies' stated environmental commitments. But more importantly, for our purposes, it has cost implications. Energy costs are skyrocketing, and AI companies are absorbing those costs with no clear path to passing them on to customers who aren't willing to pay. There's also financial engineering happening that should concern anyone who remembers 2008. AI hyperscalers are using accounting tricks to depress their reported infrastructure spending, which inflates reported profits. They're shifting massive amounts of spending off their books into SPVs, special purpose vehicles. This disguises the true cost of the AI build-out. It's the same kind of financial wizardry that preceded the housing bubble with CDOs and mortgage-backed securities. When companies resort to accounting gimmicks to hide costs, that's a red flag that the underlying economics don't support the narrative. Goldman Sachs recently noted that AI stocks now look like tech stocks did in 1997. That seems reassuring until you remember what happened in 2000. The dot-com bubble peaked in March 2000 and then crashed, wiping out trillions in market value. 1997 was 3 years before the crash. We might have time or we might not, but the comparison itself is ominous. Let me talk about historical parallels, because every financial bubble has similar patterns. In the 1990s, there was massive capital spending on fiber optic cables and telecom infrastructure. Companies took on huge debt to build out the internet backbone. When the bubble burst, a lot of those companies went bankrupt, but the infrastructure remained. The fiber optic cables didn't disappear. They became valuable eventually, just not for the original owners. The railroad boom in the 1800s followed the same pattern: massive investment, many bankruptcies, but the railroads themselves were transformative infrastructure. So here's the nuanced view. AI will likely be transformative long-term. The technology is real and useful, but that doesn't mean the current valuations are justified or that current investors will profit. As one analyst put it, it is both true that AI will transform the economy, and we're also in a bubble, and a lot of people will lose a lot of money. Both are absolutely true at the same time. Webvan failed in the dot-com crash. Instacart succeeded years later with essentially the same business model. If you were a Webvan shareholder, you lost everything, If you were an Amazon shareholder who held through the crash, you did very well eventually. The question is not whether AI is real or transformative. The question is whether current spending levels are justified by near-term revenue potential, and increasingly, the answer appears to be no. What happens when this bubble deflates? Several things. First, there will be massive layoffs in tech. We're already seeing this. Major tech companies have been cutting tens of thousands of jobs, even while increasing AI spending. They're reducing headcount to fund AI investments. If AI spending hits a wall, those laid-off workers won't be rehired. The cuts become permanent. Second, stock market corrections will hit broadly. Because AI stocks are such a large percentage of market capitalization, a correction in AI means a correction in the overall market. Third, data center construction will halt abruptly. This will affect construction jobs, equipment manufacturers, and the entire supply chain around data center build-out. Fourth, Nvidia and other semiconductor companies will face demand collapse. Nvidia's $5 trillion valuation is built on the assumption that AI chip demand continues growing exponentially. If that demand plateaus or declines, the valuation cannot be sustained. Fifth, venture capital funding for AI startups will dry up. Companies that were raising billions based on vision rather than revenue will find funding unavailable. Many will fail. The broader economic impact depends on how much of the economy is dependent on AI spending, and the answer is quite a lot. AI investment has been a major driver of US economic growth in 2025. If that investment suddenly stops, GDP growth turns negative. This is why some economists worry about a demand-led recession triggered by AI bubble fears. If investor confidence drops, spending contracts, consumer confidence falls, and we get a recession even if the underlying economy was otherwise healthy. Now let me be clear about what I'm not saying. I'm not predicting when this bubble pops. Bubbles can inflate for years beyond what seems rational. I'm not saying AI technology is worthless or won't be important. It clearly will be. What I am saying is that the gap between spending and revenue is unsustainable. The economics don't work at current technology levels, and when that reality becomes undeniable to investors, there will be a correction. What am I watching to track this? Several indicators. First, AI usage metrics at large enterprises. If adoption continues declining, that signals the productivity gains aren't materializing. Second, revenue growth at OpenAI, Anthropic, and other AI companies. If they can't show a path to profitability, investor patience will eventually run out. Third, data center construction activity. If companies start canceling or delaying data center projects, it signals they're reassessing the investment thesis. Fourth, Nvidia earnings and guidance. Nvidia is the bellwether for AI infrastructure spending. If their growth slows, it means AI spending is slowing. Fifth, venture capital funding rounds for AI startups. If valuations start coming down or funding becomes harder to raise, the bubble is deflating. So far, spending continues unabated, but the tone has shifted. The admissions from CEOs that there might be a bubble, the increasing media coverage of bubble risks, the economic analyses highlighting unsustainability, these are warning signs. For regular investors, this matters because tech stocks dominate portfolios. If you own an S&P 500 index fund, you have massive exposure to AI-related companies. If those companies correct, your retirement account corrects with them. I've personally been reducing exposure to the most speculative tech stocks and increasing allocation to value stocks and real assets. I'm not betting on imminent crash, but I'm not assuming the current trajectory is sustainable either. But again, this is what I'm doing based on my own analysis and risk tolerance. I am not a financial advisor. This is not investment advice. Everyone's situation is different. You should do your own research and consult with licensed professionals before making any financial decisions. What I am saying is this: pay attention to the gap between AI spending and AI revenue. Pay attention to what CEOs are saying about bubble risks. Pay attention to usage trends and adoption rates. The AI revolution is real, but the AI investment bubble is also real. Both can be true simultaneously, and understanding which companies and technologies will survive the inevitable correction is critical for anyone exposed to tech stocks. The dot-com crash wiped out trillions, but left behind Amazon, Google, and the infrastructure that powers modern internet commerce. The AI bubble will likely follow a similar pattern: massive investment, many failures, but real long-term transformation. The question is whether you're positioned to weather the correction and benefit from the eventual transformation, or whether you're overexposed to the speculative part of the bubble that will evaporate when reality hits. Stay informed, watch the metrics, and recognize that when spending outpaces revenue by 30 to 1, something has to give.